And welcome into Market Talk for this Friday, December 17th. Great to have you with us as we wrap up another week of trade. I'm your host, Jesse Allen. Thanks for joining us once again. MarketTalkAg.com. That's our home on the web where you can find us, MarketTalkAg.com. All of our social media links are there, streaming sources, the latest agriculture news, market information, and so much more. It's all on our website, MarketTalkAg.com. Well, as we wrap up the week, we have a pretty similar trade today as to what we had on Thursday. Few things different, though, few things of note, and we got plenty to discuss here as we wrap up the week and head towards the Christmas holiday coming up next weekend. Let's talk about all of it. Let's bring in our good friend Ted Seifried with Zaner Ag Heads joining us on a Friday. Ted, great to have you back on with us, buddy. How are you?
I'm awesome, Jesse. Great to be on. Thanks for having me.
Hey, I appreciate the time as always, Ted. Let's kick things off. I want to get your thoughts on the Fed's statement from earlier this week, that December meetings that they wrapped up after a couple of days, and just your thoughts on what we heard from the Fed regarding inflation and interest rates, and how that's all kind of shaping our markets now moving forward. Because it felt like the ag markets, especially, reacted somewhat positively to the Fed news earlier this week.
Yeah, I think well, CPI is actually I think what the ag markets were reacting more positively to. I mean, that inflation is real. We see that. I mean, we know it's there. And the Fed knows it's there too. We're continuing to taper, which is it's not raising rates, but it does similar. It has similar effects. And they talked about there was a unanimous decision that they are looking for three rate hikes in 2022, and you got to imagine that those are going to be quarter point rate hikes, so not terribly aggressive, but still they're talking rate hikes. Now, it's key to remember that the Fed is only part, or really half, of the mix of what our money flow is, right? I mean, you've got fiscal policy, but you also have monetary policy. Uh, it's interesting. It kind of sets the stage for a little bit of a standoff, in my opinion, between the White House and the Fed. You have a White House that seemingly wants to be very, very spendy and continue to throw money at what they see as a problem with coronavirus and Delta and Omicron and Omo, whatever else the next one's going to be. Versus the Fed that is realizing that inflation is a problem and longer term, this is an issue, and that we need to start bringing in the reins. Personally, I think the Fed is on the right track. I think we should be due for some rate hikes. We need to cool things off. It's not fun as a commodities trader. I mean, certainly as a consumer, I don't like inflation, but inflation can be a good thing when you're trading corn and beans and cattle and hogs and things like that. But I think the climate overall is changing, out of this whole, pandemic need for expenditure of money and free money, cheap money, no interest rates, so on and so forth, into more of a normal economy. And again, I think we've overdone some things. I think inflation is really showing its head, even more so. A lot of it, traditionally we look at the U.S. dollar index for inflation, but I don't think that's a good gauge of inflation this time around, because we're looking at a basket of currencies that other countries or other central banks are doing very similar things. I think the better gauge of inflation is commodity prices, but I really look at the stock market, Jesse. I think that stock market is really overvalued compared to what the fundamentals are. But then if you adjust for inflation, that's where we're seeing it. So yeah, I think we do need to cool things off. And it might not be fun. It might not be a 2022 could be a much different year than what we saw in 2020 and 2021 even. So yeah, I think we have to get ready for something like that. But in the short to midterm, I just think the spending that we have, and the fact that we're not raising rates right now. And yes, tapering is one thing, but not raising rates and the spending that we have, that combination, and the effects of inflation are a lingering thing. I think that will continue to be a factor into the summer. And I do think there's a tailwind for commodities as a whole over the course of the next few months still.
Well, Ted, let's break down commodities here and break them down a little more specifically. I want to start with soybeans. That was kind of the star of the week this week.
Hmm.
Now, with soybeans, we had oil really strong a couple days, and then on Friday we kind of flipped that spread between meal and oil again, and
Right.
and meal kind of took the lead, and soybeans were still strong. We got some sales to China. We've had a couple soybean oil sales to India this week.
Hmm.
What's your thoughts with this soy complex and that continued that back and forth that appears between that meal oil spread right now?
The products were volatile, and the jockeying for share in the crush spread very active this week because there was a lot of news for the products this week. We had Nopa Crush, and that the oil stocks came in lower than expected. That added strength to oil, and like you said, some pretty massive sales of soybean oil to India, which they traditionally are really heavy on palm oil. So it's very interesting to see that, and it's really encouraging. I mean, you really like seeing that. You also had a lot of movement in crude oil, so soybean oil was really being pulled in all sorts of directions this week. The meal movements were a little bit more subtle. Uh, and I think that's interesting because meal has had a really nice rally off of lows. And for the most part, on days where I felt like the crush spread could have put a lot of pressure on meal, it really didn't. Meal on its worst days really treaded water very well, and on its best days had some pretty decent strength. I still think that meal chart looks like we have more strength, more upside potential there. Global feedstock demand is very strong. We know that. I think meal, and we talked about it last time. I think meal had gotten down into levels that were just way too cheap. So again, I look for more upside strength in meal. I think oil is now kind of turning the corner. We've obviously broken off of highs pretty significantly, but this volatility that we've seen this week and the price action that we've seen this week, to me, kind of suggests that we're finding a near-term low. So I think this really strong crush margins that we're seeing right now are only going to gain. I think the crush, while it did disappoint a little bit when we saw it earlier in the week, it's still at stronger levels. That is only going to get stronger and stronger. So I think that's going to be a shining spot of the balance sheet going forward. And then, soybeans as a whole. Wow, from a technical standpoint, for the last couple of months, we've been putting in this massive inverse head and shoulders formation. And that doesn't necessarily mean that a bottom's in. We can break that formation and go in and make new lows. But as of right now, just the way it stands, I really kind of wonder if we've got a multi-month low in place for the soybeans with some pretty significant upside potential. Obviously, we're watching South American weather very closely. For the most part, the vast majority of the growing area in Brazil looks really good. We do have some concerns about southern Brazil and Argentina, which, by the way, simmered down a little bit midday Friday with a little bit of a change in the forecast. But we have that weather risk concern, and we have a concern about potentially gaining more acres in soybeans for this coming growing season. However, I think the longer we think about that, the more we realize that we're probably not going to see that bigger shift. So you've got a market that had kind of been factoring in a big increase in acres that now I think is starting to take that away. But we talked about inflation and things like that. I think overall maybe soybeans had gotten too cheap. Again, I think that crush margin is going to continue to be strong. I think the crush is going to continue to be strong. We're seeing exports catch up to the USDA's projections. We don't need to be at the exports that we had last year in order to hit the USDA's balance sheet. And I think the market is realizing that as well. So I see upside potential. I really like the look of the charts. I like the activity that we saw on Friday, even though we did fade off the highs. To me, it looks like we're on the verge of a technical breakout, and I think we have some positive fundamentals there to do it. A lot of people have been very, very bearish, and Jesse, a lot of times that's when you kind of put in a low. And the big wild card here, and this goes for soybeans, but really all of the markets, is the time frame that we're in. Holiday season. We usually expect to be really very quiet during this time frame. But last year we were really very active. Corn was really strong during this time frame, and by the time your commercials and your professional traders got back after the holidays, they were having to chase corn higher. So I don't know what we're going to see in the next 2 weeks. I'm really very curious. I want to lean towards a bit of a more quiet time frame, but as we saw last year, that doesn't necessarily have to be the case.
You mentioned South American weather and some of those dryness concerns, and that is going to play into the corn market, I think, as well,
Yeah.
especially as we start to get that first crop off and start to think about planting the safrinha crop in South America, that second corn crop. This
Hmm.
corn market, we keep testing that $6 mark. We continue
Hmm.
to test it. We try to reach that old high, 5.99 at three quarters, and then we keep encountering selling. Right as we get to that mark, we just can't seem to push through it. And we've talked about this before, but what's your thoughts as we head into the Christmas holiday and the end of the year? Do you foresee us possibly finding a way to break through six?
Sorry, I just have this song playing in my head. You keep a knocking, but you can't come in. Right? But hey, I like to say I say I don't like cliches, but then I end up using a lot of them, I feel like. But you keep knocking on a door, eventually that door kind of opens, right? Or usually that
Mhm.
door opens. It's not always the case, at some point the market gives up and fails. But I don't feel like that's the case. I really do feel like corn is going to get up and over that $6 mark for a number of reasons. And there on Friday, we got really close to it. And then again, you had a little bit of a change in the forecast midday, so things cooled off. But for me, I think if you see a close in the March corn over 596 and three quarters, then you're pretty much a given to get over six. And at that point, I think you're talking 612 ish minimally, really. So that's kind of what I see for the corn market. I don't we have South American weather risk, like you talked about. This safrinha corn crop for me is a huge question mark. We've talked a lot about acreage and what's going to happen here in this country as far as input costs and are we going to plant corn and like I said, I really believe we're going to stay pretty close to our normal rotation here in the United States. And I think the market's kind of feeling more and more of that. But I think the story that's not really getting talked about enough is what is going to happen with the acreage for that safrinha corn crop because that's sort of an afterthought for them. Their bread and butter is the soybean crop, right? That's their main thing. Which is going well for them right now, by the way. And you look at input costs, and they're going to have to be purchasing, if they haven't already, they're going to be purchasing inputs sooner than we are. So there isn't going to be this time frame for natural gas, which has come down very significantly to filter through into lower priced inputs. They're going to be buying into some really high prices, some inputs that were produced with some very high inputs into the inputs, so to speak. Um, so are they going to really want to push the envelope there? Is it worth the risk for them? Are they going to maybe cut back on some acreage? I feel like they could a little bit. But more importantly, are they going to hold back on some of the inputs? And I think that it's going to be a really uphill battle for them to get to the USDA's projection of their production. Could it be 2 to 4 million metric tons less than what the USDA has planned? And put that together with maybe a reduction in Argentina and southern Brazil first season crop, based on the La Nina growing season. So maybe South American corn production drops 6, 7, 8 million metric tons. And if that's the case, corn market's going to have to really make sure we get those acres planted. So I really feel like the time frame between now and our planting season could be a rather strong one for corn, ensuring that those acres get planted. And I also feel like the big proving ground for will inputs matter to acreage. I think we're going to see that in South America. We're going to see that play out in South America first before we even get to our planting season. So I am very curious to see what happens in South America, but specifically that second season Brazil safrinha corn crop.
On the wheat market, briefly, Ted, what are your thoughts with some of the damage we saw throughout the Plain States this week? Is that the big driver into a little bit of the rally we saw in wheat this week, or is it the dryness in the southwestern plains, or what do you see in there? And I think the flip side of that too is that during the winter months, I mean, we get a rally in wheat, and it typically, if it's a weather rally, it doesn't necessarily last all that long. When it's over, it's over.
Yeah, right. Absolutely right. And we saw that when it's over happen kind of earlier in the week, and that was happening right during some major weather issues. When that wind was coming through, and that was, I think, a statement from the wheat market saying, "Yeah, okay, we're a little bit overpriced at this point." Um, that being said, the strength that we saw later in the week was kind of recovering from that. We bounced off a key support level in the week. I do think there was actually some damage done. I'm really disappointed the wheat market didn't pay more or give more credence to the weather events that we had throughout the week. And then also the dryness in the plains, like you talked about. I think there are weather reasons for wheat to be higher, but it's just very reluctant to do that. I do think wheat can go higher, but it really has to be led by the row crops. If you get that corn breaking out like we had talked about, if soybeans continue their breakout to the upside, up and over this downtrend line that they were able to achieve this week, I think wheat will be a reluctant follower um, rather than a leader to the downside. So yeah, the wheat market again. I think the time in the sun for the wheat, where wheat was rallying and the row crops were kind of reluctantly following along or trying to, that time has passed. Now it's the row crops that have to take that leadership role and try to pull wheat to the upside. If that doesn't happen, then I think wheat is looking kind of iffy on a chart right now.
Over in livestock, just want to touch on that today as well as we wrap up the week. Cattle cash trade's been pretty disappointing this week. Hogs on Friday we're okay on the board, but as we head into the Christmas holiday, it's starting to feel like we're kind of hitting that holiday slog, so to speak, throughout livestock. What are you seeing there, Ted?
Yeah, and it didn't really feel like that in the grains this week. We had some volatility, we had quite a bit of movement. We didn't really get that though in the livestock. The livestock trade did really feel like pre-holiday trade, in that livestock could be really fairly quiet, as we go through the next 2 weeks. But then again, who knows? I remember what was it, 2003. I
Hmm.
was the low man in the totem pole at the firm I was at the time, so I draw duty on Christmas Eve trade day, and that's when we had the big mad cow deal, and things went really crazy. So there's always something that can happen. But I just don't really expect that this time around. Um, yeah, cash has kind of cooled off a little bit. Packers margins are still really good, and I wonder if this was just a little bit of a correction in the cash market. Our domestic demand is solid. Export demand, you can always want more exports, but it's not terrible. So I don't know. I think the cash could rebound. I also feel like the futures have come down enough for the time frame. We're right at trendline support. I kind of feel like the lows that we saw in the Fed fat cattle there at the end of the week Thursday, and we kind of retested them on Friday. I wonder if that's going to be the low. I wonder if we can start to try to bounce from here. But we really need to hold that Thursday low because that is trend line. And if we can't do that early in the week next week in the thinner holiday trade, you could see some very interesting kind of weird moves next week and possibly a flush out to the downside. I'm hoping that's not the case. And again, fundamentally, I feel like maybe we don't need to make new highs over that 142 mark in the Fed, but I could see us trading 138 to 140. I feel like that's kind of a value area. So we'll have to wait and see what happens with the cash developing over the next couple of weeks to see how that plays out and if that should be the leader. Now, hogs, that's the more interesting of the two, in my opinion. I feel like hogs had gotten really rather undervalued, and we have fundamental reason and justification to be higher. We have lesser animals. I do get that December contract had been a really I don't know, say cancerous. It'd been a problem for the board because we had these higher weights, which mean marketings were slow. So we had upfront production that we had to work through. I think we're in the process of doing that now, Jesse. Domestic demand is good. You've seen a rebound in cash prices, cutout values. And I got to say, the hog chart is a very interesting one. You have this big, broad, inverted head and shoulders formation. It could be a long-term bottoming. It's kind of similar to what we see in the soybeans, only maybe even more defined and more profound. I really think that hogs should be trading in the mid to upper 80s to lower 90s. So we're a ways away from that. I see quite a bit of upside potential there. And I think the chart setup is finally right to say, hey, I'm fairly comfortable that the low is in for hogs, barring some unforeseen, just catastrophic event. I'm not going to say the A word. Um, as long as nothing like that happens, I think there's a fairly clear path to the upside in the hog market right now.
Ted, great stuff as always as we head to Christmas and New Year's and head to those last 2 weeks of the year and what's typically a quiet time of trading and marketing. Any advice or any final thoughts you want to share with folks before we get to the holidays?
Yeah, right. This is the time of year where it's pretty easy to kind of sleep on things, and generally we do that. But I want to remind everybody, if you're producing corn and beans, um, we are at some really very good prices. And while everything we just talked about leads me to believe that there can be some upside potential from a chart perspective, I really like the setups that we have going into the beginning of the year. There are certainly a lot of things that can change. There's a lot of things that can push us lower, right? So you have to manage your risk. And, in a year like this, when I look at December 22 corn trading 550, I want guys to look at cash sales as their chief risk marketing or risk management tool. But also, guys don't like to sell because they're worried there's upside potential. So they see or hear somebody like me talking about, oh, I like the setup of the soybean chart. I think there's good reason for corn to rally. Okay, but there's other ways of expressing bullishness. There's other ways of re-owning upside potential, and so make those cash sales. Basis is really strong right now, and prices are really good. Make those cash sales, but then come in and buy like a call spread going out into, say, like a 640, 740 call spread in July corn for roughly 17 cents. Use that as your upside potential. Don't let markets and somebody's positive outlook on the markets keep you from doing your marketing. This is something that you have to do right now. These are very good prices. I'd like to see guys, and this is what I tell my clients, I want to be 70, maybe 80% sold on old crop corn at this point. That's a lot more than we usually are at this time of year. But I want to be fairly aggressive on corn sales because of the combination of good prices and good bases. But also I want to see guys, 30 to 40% sold on new crop at this point. Maybe more, that's more heavier on beans. Corn, I'm okay with 20 to 30%, somewhere in that neighborhood. But I want to be making these sales. We have the prices to do it. We know we're profitable. Go back 2 years ago when we were 330 corn and 880 beans. That's not the situation. These are opportunities. You have to lock them in. There's lesser risk ways to re-own that opportunity to the upside, and that is just the smart way of managing risk at this point.
Well, Ted, I know if folks need a little advice and help, you and the team there at Zaner Ag Hedge could help them out. What's the best way to get a hold of you guys?
Yeah, you can find us on the web at www.zaner, that's zaner.com. You can read about us. You can also sign up for our morning Ag Hedge newsletter, which, by the way, is just a newsletter. There's no market recommendations or anything in there. Our market recommendations come from working with us on a one-to-one basis because we want to know your operation as best as we can so we can advise you as if we're part of your operation. That's our point, right? But yeah, you can reach me directly at 312-277-0113. That's my direct line. If I can pick up, I will. Otherwise, leave a voicemail. I'll call you back. Also, lastly, you can find me on Twitter at the Ted Spread. I talk about grains and marketing, also cars, ethanol, hot dogs, whether they're sandwiches or not, which they are, by the way. But I like to have fun on my Twitter account. It's not just professional Ted, But yeah, if that's your thing, check it out.
We have professional Ted and fun Ted all in one on Twitter at the Ted Spread.
Peloton Ted apparently too.
Peloton Ted as well. Find him online as well for all the marketing advice, Zaner.com. Ted Seifried with Zaner Ag Hedge. We appreciate the time as always. Merry Christmas, buddy, and we'll talk to you real soon.
Thanks, buddy. You too. Have a great one. Talk to you soon.
This has been Market Talk for this Friday, December 17th. Find us at markettalkag.com. I'm Jesse Allen. Have a great afternoon.